All right, everybody, welcome back to another episode of Inspired Investing. My name is Christopher Cox, and I'm joined by my co-host, Nicholas Marcano. We're going to be discussing asset valuation and financial statements. So some of the questions that we'll be answering today is how can you make an informed estimate of a stock price? What are the tools available to you to determine a company's worth? And then how can you use these tools to determine the value as an educated investor?
So there are several tools that you can use in order to value a company. Before investing in any stock, it is important to have a general rough estimate of what you think a company is worth. Only then you'll be able to determine what specific price that you should be paying for it. Valuations can either be quantitative or qualitative. A quantitative approach looks at a company's business fundamentals, so it focuses on their intrinsic value, whereas a qualitative approach can be arbitrary and based on individual perceptions of a company. So firstly, you can utilize a relative valuation strategy, which is an approach that compares similar companies operating in similar industries and judges them based off of each other. A company's current ratio measures their ability to repay short-term liabilities. The calculation is pretty simple. It is basically a company's current assets divided by its current liabilities, and it measures how well that company is able to liquidate their current assets to cover their current liabilities. The second tool that you can use to develop an understanding of a company's value is the PE ratio, or its price to earnings ratio. The PE ratio shows the relationship between a company's share price and its earnings per share. This is calculated by dividing a company's share price or stock price by their earnings per share. The third tool that you can utilize to paint a clear picture of a company's overall value is their debt to equity ratio. The debt to equity ratio is an important metric that can be used to determine how much debt a company has relative to their shareholders' equity. A company with too much debt can be a red flag for investors unless they have tremendous growth potential or are investing in highly productive assets that will be able to generate exponential growth or earnings in the future.
First, we're going to talk about the income statement. Income statement has two sections, the revenues and expenses. So your revenues are going to come in the form of sales, and then your expenses will be subtracted from that, which will be your income for the company. Then we'll move on to the balance sheet. The balance sheet lists assets and liabilities. So what your company owns, whether it's tangible or intangible, and the value attached to the liabilities, on the other hand, or what the company owes to debt holders or anything of that nature. The cash flow statement is a very important statement, arguably the most important, where you understand how much cash the company is generating. So you have three important areas, which are operating, investing, and financial activities. So your operating activities will be how much cash is the company generating from its business, so what it sells. The investing activities is going to be what the company generates or what the company buys, whether it's securities, purchases of physical assets, or the sale of securities. And then lastly, we have the financial activities, which includes the dealing, selling and buying of bonds, and also deals with the sale of stocks and other financing.
So the financial statements are simply written records of business activities and financial performance. So you can utilize a company's earnings report in their financial statements and use that to help you make an informed decision and decide whether or not a company is worth investing in. So next, we're going to be moving on to our Habits for Success segment. In this week's episode, we'd like to highlight a few tips and quotes from The Intelligent Investor. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. In The Intelligent Investor, Benjamin Graham also highlights that the kind of securities to be purchased and the rate of return to be sought depend not only on the investor's financial resources, but also on his financial equipment in terms of his knowledge, experience, and temperament. So it isn't just solely about your money, but it is about your understanding of the strategies and tools at your disposal to make sound investment decisions. This may appear to be very repetitive, but it is derived from an approach that ensures the safety of principle. Benjamin Graham also argues that the intelligent investor must never try to forecast the future exclusively by conjuring the past. You want to ensure that you are taking several different perspectives into consideration before making an investment decision. The future value that you've estimated a company to be worth is not just based on past performance. It has to take their current and present operations into consideration. So these are key things that Benjamin Graham advocates for us to pay close attention to before making a decision or bold prediction on a particular company's worth.
With that being said, we're going to move on to what's trending globally. In the investing business world and financial world, one thing I want to address is the regime investing. Has been very popular recently, and regime investing is when you make an investing decision based on a future presidential regime, whether it's Republican or Democratic, and it's important to make a decision off of a long-term goal. And 4 and 8 years as it pertains to investing is not an incredibly long term. The important point here is that you want to have a portfolio with an assorted type of equities that are going to perform well in Democratic regime, stocks that are also going to perform well in Republican regime. So you get a diversified amount of stocks there for a long-term investment plan.
We can't stress enough how important it is for you to implement careful selection and critical analysis in your investment decisions. We can only recommend that you consider credible sources and do your due diligence before making your investment decisions.
Thanks for watching, guys.
Your decisions compound, your money should too. Thanks for watching.